Right, so for today's lesson, what I'm going to do briefly is I'm going to focus a little bit on life assurance. We briefly touched on this the last time. Um, Obviously, last week as well, we looked at car insurance. That's one of the main, I suppose, areas at the beginning of this chapter. And I got you to look up kind of different insurance companies, and I know some of them mightn't be able to give you information, so some people might have struggled to get it off some insurance companies because you didn't actually have a car yourself to insure. But it's just, even if you just watch the video and just seeing the process, it's just kind of bringing the chapter more to life. So today we're looking at a little bit on life assurance, but a lot of the class will be focused on calculations for house insurance. And I've done up this video not as a live class, but as a pre-recorded video because there's a good bit of calculations, and I feel like it might be more handy for you to have this video. So up on YouTube to pause and rewind, and if there's a calculation that you are not sure of, then you can obviously pause it and try to make sense of it compared to a live class when if you miss it, you miss it. So for life assurance, I briefly touched on this the last day. This is life assurance. So what do I mean? Our chapter here is focused on insurance, obviously insurance with an I. For life assurance, we're assuring ourselves against something that will happen. So insurance, which we have looked at up here at the top, which is what is insurance. We can see our compensation is the financial payment to somebody if they suffer a loss. So for insurance is all about protection against something that may happen, against a possible loss, something that could happen. So insurance is, protection against something that could happen, whereas assurance is protection against something that will happen. And the only thing that will happen is death. Sorry to be so morbid, but that's life assurance. So it's protection against death. Life assurance policy pays out when the insured person dies, not if they die, because it's an eventuality. So for life assurance, what happens is the policy holder, so it's the person themselves, it's in this case, just say there's the person John, and John takes out life assurance. So let's say he does it when he's 30. John might pay the company, the assurance company, you might pay for life insurance maybe every single month for 30 years. So what does all that mean and what happens? And I'll go through it here. So there's these are the three main types of life assurance cover. So the first one is very expensive. It's called whole life policy, and it pays compensation on the death of the insured person. So basically you pay money into the insurance company for this assurance, and when you die, your family or the people, your next of kin, the people you choose, will receive a larger payout. So obviously, generally it's done if there is, let's say, a family and one of the parents is the bigger earner. Let's say there's only one parent that's working, they're a bigger earner, and they take out life assurance just in case something was to happen to them, that there'd be money set aside for the family. So that's a whole life policy. It covers your whole life. Term policy is the second one, so it's a fixed time period. So what might happen here is you might only take out life assurance so that if you were to pass away from between 30 years old to 55 years old, because that's usually the length of time that someone might be working, and earning a lot of money. So you might take out a term policy that if you were to pass away during that time period, you'd receive the large payout. So what happens here is somebody might pay in €100 a month, every month for 20 years. That would total to €24,000 that you would pay the assurance company. And then what would happen is if that person was to then pass on, that their family would receive a large payout, maybe $250,000. If that time passes, this isn't like whole life policy. When you die, you receive the money, but for term policy, you pick a specific time. So maybe from 30 years old to 55 years old. And once you're 55, it's now finished. But you do get the money back that you paid in, but obviously there'll be no payout once you die. Endowment policy, it's a guaranteed amount on a specific date, or if it occurs sooner on the death of the insured person. So again, just basically these are forms of investments that people have just in case something happens to them. What happens here is that you pay in money, a certain amount of money, let's say every month, and you pick a date in the future, and if you die before that date, your family receives a large payout. Or if you die on that date, if you die before that date, your family receives a large payout, and if you don't die, then on that date you receive the money. So this is more like an investment. So it's basically saying that if I put away, and I put in €30,000 to an endowment policy, and I set the date for 2060, by the date 1st of January 2060, if I have an endowment policy, I'll receive all of my money back. And if I die before that time, then my family will receive the money. These are just forms of savings, they're forms of investment. So I think with this slide taken on the last day, these two lines, one of the bit lines here, I'm just going to get you to take this down as the 3 different types of life assurance covers, the main 3 types. So that's life assurance. Generally can just pop up as a small short question for the junior cert, generally just to maybe ask you to explain one of these 3, or else to explain life assurance versus insurance. So as we said at the top, insurance is protection against a possible loss, but life assurance is protection against something that will happen, so when the insured person dies. So that's life assurance. There's one more thing I want to cover, and I'll get to this one first, and then I'll get to calculating. I'll look at this the next day actually. I want to focus on house insurance premiums. So we've looked at house insurance before. So for house insurance, I'm just going to go back up to where we've seen it here. So for home insurance here, we see that this covers the building, your house, in the event of a fire, flood, storm, or anything like that. Generally, it's natural disasters. So it's basically protection against any damage to your house. And you also have contents cover, so that you can see here in the photo, if your house is flooded, you decide on how much the contents in your houses are worth, and you insure your house so that there's, you receive a payout if all that stuff is damaged. How do you calculate it? So what we have here, and this is just taken out of your book, I'm just going to focus on here what's on the screen. This is a little example. So Margaret Finley's house insurance is due for renewal. Her insurance company has given her a quote of €12 per 10,000 value for the house and €20 per 5,000 value for the contents. So this is just something that the insurance company is telling her. This is the rate. We'll get to that in a second. Don't worry about it now. She estimates that she should insure her house for €180,000 and her contents for €90,000. Calculate the insurance premium Margaret will have to pay. So what we're looking at here is that she's trying to insure her house for €180,000 and all of the stuff in her house, her contents, for €90,000. So that if her house was to be completely flooded, destroyed completely by a flood, she'd receive €180,000 for her house and €90,000 for all of the stuff in her house. So she'd receive €270,000 in total. So this is what we're looking at here. That's how much she's trying to insure her house and her contents for. Okay, so in the event of damage, she'll receive all that money. So if that's how much money she plans on receiving if the house is destroyed, how much should she pay for the insurance? Because remember, you don't just get this money from free from the insurance company. You have to pay them money generally, per month or per year. You have to pay a certain amount to them so that if this does happen and the stuff is completely destroyed, then only then can you receive your money. So now we need to find out how much her premium is. How much does Margaret need to pay every single year in order for her to have this money available if her house is destroyed? So how do we calculate it for house insurance? Well, she values her house at €180,000. And the insurance company has given her a quote and said that for every €10,000 value in her house, she's to pay €12. So for every €10,000 in value, she's to pay €12. Her house is worth 180,000. So how many times will she have to pay that 12? For every 10,000, she pay €12, and the house is worth 180,000. So to calculate that, all we do here is we take the value of the house, 180,000, we divide it by the 10,000 and multiply it by 12. And you will do this for both house insurance, for the contents, every single time. It's always the same. You take the big number here, value of the house, put it on top, and you divide by the 10,000 multiplied by the 12. You want to see how many times 10,000 goes into 180,000, and then we're just multiplying it by 12. So that's how we do. 180,000 divided by 10,000 multiplied by 12, and we work all that out here to be 216 euros. If you put that into the calculator here, you get 216 euro. Now that's house. That she's to pay 216 euro per year for house insurance every single year. And if her house is destroyed, she'll receive 180,000 euro. So what about contents? Contents of our house, all of the stuff in our house, all our furniture, jewelry, everything like that, TVs. 90,000 euro she estimates to be the value of her contents. If they were completely destroyed, she would look to get 90,000 euro. So how much does the insurance company value the contents? So for every 5,000 euro, she'll have to pay 20 euro. So for every 5,000 euro of her contents, she'll have to pay 20 euro. So her contents are not valued at 5,000, they're valued at 90,000. So how much times will she have to pay that 20 euro? So again, what do? We take the big number, 90,000, we divide it by the 5,000, multiplied by 20. So how many times does this work into that? So 90,000 divided by 5,000 multiplied by 20, work that out in the calculator to be 360 euro. So she's to pay 216 euro for the house insurance every year and 360 euro for the contents insurance every single year. Okay, she's to total that at 576 euro, and that's how much she'll pay for her house insurance. So 576 euro. So house and contents. So that's our example there. All we've done is we've taken those bigger numbers, we divided by the information that they give us. For every 10,000 to pay 12 euros. So divided by the 10,000, divided by the 12. What information do they give us here? For every 5,000, multiply by 20. Divided by 5, multiplied by 20. So that's our first example. Now I'm going to go through another one just because there's a little bit more information to it. I have just one more question here that I'm going to go through, and then I'll be giving you questions for homework. So this next one here. So Reese is looking for new house insurance. He has some expensive sports equipment that will need to be insured separately because of its specialist nature. He calculates that he needs to make the following insurance provisions. So basically this is the same again. This is how much his buildings are worth, 450,000 euro. His general contents, so the contents of a house, again all the furniture, jewellery, everything like that, is worth 110,000 euro. And his sports equipment is worth 3,000 euro. So how much will it cost Riza to insure all of this? Two different insurance companies, and they're giving us two different rates, and we need to find out which one offers the best value for money. So let's look at it here. The first one is Insure All Limited. They charge €1.50 per 1,000 euro for the buildings, €5 per 1,000 for the contents, and €20 per 1,000 for the sports equipment. So how would we go calculating Insure All? Okay, I know again that the value of buildings are 450,000. For every 1,000 euro, they charge €1.50. So let's look at this here. What I'm going to do is I am just going to cover all this up here, and we're just going to focus on it bit by bit. So house, value of the house, 450,000 euro. For every 1,000 euro, we pay 150. So 450,000 divided by 1,000 multiplied by 150. Divided by 1,000 multiplied by 150, you have to pay 675 euro for house insurance. What about general contents for Insure All? General contents, for every 1,000 euro, we pay 5. It's worth 110. So take the big number, 110, divided by 1,000 multiplied by 5. Again, I'm going to show this here. So we have the big number there, 110,000, divided by 1,000 multiplied by 5. It's 550 for contents. And the last one, sports equipment. For every 1,000 euro, we pay 20. Sports equipment are worth 3,000. So take the big number, 3,000, divided by the 1,000, multiplied by the 20. And once we've done that now, I've worked out all three. So, and I can add them all up then at the very end. Sports equipment, so I have my sports equipment there is worth 3,000. Sports equipment divided by my 1,000 here, multiplied by my 20, gives me €60. I've worked out all these three figures. What do? Add them up. So for insure all, if I'm to insure my buildings, general contents, and sports equipment with this company, that's how much it'll cost me. With the second company, Cover for You Limited, and it's the exact same. €1,000 for every €1,000 for the buildings, that's what they charge. Every 1,000 for the contents, that's what they charge. And then this sports equipment is a little different. I'll get to that in a second. So again, buildings, general contents, quickly calculating it. Buildings, 450,000 was the value of the buildings, and 110,000 was the value of the contents. So again, take those big numbers, divided by the thousands, and then multiplied by, this isn't equals, this is multiplied by the value. 450,000 divided by 1,000 for buildings, multiplied by €1.35. And again, 110,000 divided by 1,000, multiplied by 450. These are my buildings, these are my contents. Buildings, contents, exact same. So this is our third time looking at this, so you should be quite familiar with it at this stage. And if there's something you're not really sure, you can pause, rewind, see how we did it, and then come back to this one. Cover for You, the last one they gave us here for our equipment. So for the equipment, it's a flat rate of €120 for sports equipment up to €5,000. Flat rate means it stays the same. So if my equipment is anything up to the value of 5,000, so if my equipment is worth €1, or if it's worth €5,000, whatever it is, any monetary amount between that, then we will pay €120 for that insurance. How much is my equipment worth? 3,000. So it's already up to the value of 5,000. So it fits in here, and I just pay €120. I don't have to calculate anything. My insurance for my sports equipment is 120. So all I'm saying here is just that it's for the flat rate. So look at this here. Sports equipment flat rate up to €5,000, you pay 120. I have all three of these figures. What do I do again? Add them up. My second company here, the second company is called Cover for You. So Cover for You to insure my house, contents, and sports equipment will cost me €1,222.50. The insure for all, to cover all of that there, it's going to cost me €1,285. So this is how much this company, insure all, and this is Cover for You. Which one's more expensive? The insure all is more expensive. So the Cover You is obviously going to save me more money. So I've just given a brief description of that here. I'll just bring this line in. Insure all, sorry, I mixed up the numbers. My Cover for You. Cover for You Limited offers the best value for money. This is cheaper. It is €62 cheaper than Insure All. Let's get rid of the limit. All we've done is we've calculated, they've told us how much the buildings are worth, contents, sports equipment. That's how much this company charges. That's how much this company charges. Which one offers the best value for money? And the best value for money is the cheaper one. That's how much Insure All worked out to be. That's how much Cover for You worked out to be. So which one's cheaper? Cover for You. So Cover for You offers the best value for money. It is €62.50 cheaper than Insure All. And that's calculating house insurance. So that's our calculating the premium for house insurance. That's our lesson for today. What I'm going to do now is I'm going to give you just questions that you can work on for the calculating house insurance premiums. I'll just give you questions again, and we'll go through it again the next step. So our next class again, on Wednesday, I'll be going through the answers for the homework. See you then.